Hi everybody. Welcome to the show. How's everybody doing today? Hope you're having a lovely Thursday. Here we are at the end of summer, so hopefully everyone's been able to get outside and enjoy some nice weather and are kind of ready to join me and talk a little bit about sustainable investing so much. I know my streaming schedule has been a little choppy lately, just really trying to figure out something that does work for me and my business. It takes a lot of time and honestly energy to do these shows. So haven't done it for the last few weeks. I think I'm going to sort of take a couple weeks off. I'm having a little vacation that first week in September after Labor Day. Actually going to take some real time off, which is nice. So really going to think about what makes sense in terms of live content versus taped content and looking to take my business in some fun and exciting directions. So stay tuned on that. There'll definitely be more content being thrown up on my YouTube channel. So really encourage you to subscribe to that channel so that you will get all the latest, whether it's a live episode or whether it is going to be something a little more scripted that, for you to be able to follow that and make sure that you get it as soon as it's available. Hi, Lauren. Thanks for joining, everyone for joining. Thank you so much. I do have a slightly better mic setup. I got a little boom set up for my mic, so hopefully you can hear me loud and clear and see me loud and clear. I did get a nice little haircut. I got my COVID haircut finally. Cases here in Ontario are quite low right now, so really trying to take advantage. So getting a haircut and visiting the dentist and going to visit my little nieces and nephews who I haven't seen in far too long this weekend, so really looking forward to that. I've got a fun episode lined up for you today. I do have some tabs up here that I've kind of prepped and sort of have things ready to go. So we'll start with a little market outlook. I find it's a useful exercise just to talk about sort of where we're at, what's going on. From there, I am going to talk to you just a little bit about this idea of stock splits. A lot of big companies are doing it, and so I think it's important that people understand what's going on and how it impacts your portfolio. And then from there, I do have a few little slides here about really the state of responsible investing, both in Canada and in the US. But it's been a really interesting first half of the year. So just really wanted to share my findings and kind of talk to you about what's going on and the momentum that I'm seeing behind responsible investing right now. Personally, I think it's really exciting. So want to make sure that we do communicate that. And then from there, I'm here to answer questions. Happy to stick around. If there are specific things you want to go through, always happy to do that. Oh, Grant, you're on here as well. Welcome. Thanks so much for tuning in. It means so much to me that people watch this. So, okay, let's start with the All Country World Index. This is my standard benchmark for the global stock market. So when we look at the All Country World Index, we can chart it. Obviously you can see here, this would be over the last couple of years and really the crash and then the recovery. And you can see that we are almost exactly where we were at the start of the crash, which is remarkable that it has bounced up this much. When we had sort of hit a patch here, I was like, okay, it looks like it won't be a V-shaped recovery, at least in terms of the stock market it is. Obviously, the US economy and the Canadian economy are still going through a lot of trouble when it comes to unemployment, when it comes to sort of Main Street economic issues. But when it does come to Wall Street, Bay Street, they're looking really good right now. Markets have responded quite well. You can see that we are actually slightly ahead of where we were at the start of the year. So for a lot of investors, to watch your shares tumble about 30%, 33% I think it was down, they've now come pretty much all the way back up, which is just incredible to see that. Other things, I do like taking a quick look at the VIX. The volatility index has continued to drop. So we're now sitting at about 23. Remember, this is a measure of the volatility of the markets. So it was sort of nice and calm for a while. Below 20 is sort of where I like it to be. And then kind of at the start of the year spiked up, fell down, and then whoa, jumped up all the way to 66, meaning the markets were 3 times more volatile than I wanted them to be. This was when things were quite chaotic. And then they really have settled back down. So we're not quite below that 20 threshold that, to me, I've been sort of eyeing for when markets have settled down. But we're so close to it that, if people do want to sell mutual funds or transfer accounts, things that are going to take several days or even several weeks to process, I am now comfortable going ahead and making those transactions. When the market was really volatile, obviously we didn't want to do that, right? Because if the lag was too long, then you might miss some of those big upticks, which we have been seeing. So, really, but that said, now I would say that things are calm enough that I do feel comfortable making those sort of leggy transactions. Exchange traded funds, ETFs, are great in that the trades go through instantly, so I can sell something and buy something else right away. But when it comes to mutual funds, or if you're looking to switch from one institution to another, it does take time. You are going to be out of the market, so we want to see that low volatility while we are still going to be out of the market. So from there, it is nice to take a look at oil prices. Oil prices have continued to bounce back up ever so slightly. So you can see, obviously, this was when it went negative for that ridiculous day. And then now it's just been very, very cautiously climbing back up. We're now at $42 per barrel for light crude oil. And then here in Canada, the metric we care about is this WCS, this Western Canadian Select. So, at $30 a barrel. So again, this is below break even. A lot of them do need it to be at about 35 or $40 for this WCS to break even. And certainly we have seen a lot of new projects getting canceled if they're going to be more expensive. That said, we're certainly not in the dire straits that we were. And that, this economic recovery, at least in terms of the markets, is proving to be fairly stable. So happy to see that. To me, these are good signs. A little bit worried about, the U.S. election and that, the fact that markets came back just as high as they were. If the U.S. were to shut down or there's a big problem in the U.S. election, would be cautious there. But the fact that we are kind of back to these levels, right, of kind of where we were before the crash, really tells me that, likely if you haven't rebalanced for a little while, now is definitely a good time to rebalance. Like in a dream world, people would have rebalanced right at the top when things were really high at the start of the year. They would have rebalanced right at the bottom, meaning they would have, basically bought more bonds at the top to be a little bit safer or, to have the appropriate risk level. And then as the market crashed, your shares would have fallen, right? But your bonds would have remained stable or even up a little bit. And then from there, you would have sold your bonds to buy stocks at this low level had we rebalanced right at the low. And had you done that, well, now your stocks have bounced back up so much that you're probably at a higher risk level than you should be. As well, if you just hadn't rebalanced, you're one of these people that hasn't rebalanced for the last 2 years, well, then again, your stocks are probably up kind of back to where they were at the start of the year. That really now I would say is a good time to rebalance to make sure that you are at that appropriate risk level. So that's really it from my market overview. Stock market has really been bouncing back up, even though I know there are these massive problems with unemployment and with real estate and, with back to school coming up and cold and flu season. Certainly there are a lot of concerns around COVID, but the stock market doesn't really seem to be pricing those in. The stock market is very much pricing in I would say a pretty solid recovery here. So it is what it is. If you've got questions, let me know. Otherwise, that's it for the market overview, and I'm going to move on to stock splits. All right. So stock splits are a really interesting phenomenon when it comes to the stock market. Basically, what happens is that over time, share prices go up, right? And that as the share prices go up, especially if a company's done really well, their share price can get so high that it actually becomes very inaccessible for investors, that it makes it really hard to buy a share. So typically when stocks are doing really well, they consider this idea of a stock split. Now, I want to be clear that when it comes to a stock split, this doesn't affect the company's financials at all. Really, this is just a mechanism to make it cheaper and more accessible. Really what we're trying to do here is to keep the company's market value at the same level And if the market is going to be, the market cap is at the same level, but there are more shares in the market, then really what you're doing is lowering the price of the share, your price per share, while keeping the company's value at the same level. So this gets a little bit tricky. You can see the definition here on Investopedia. A stock split is when a company divides the existing shares of its stock into multiple new shares to boost the stock's liquidity. So hopefully this means that people are going to be buying and selling more often. Although the number of shares outstanding increases by a specific multiple, the total dollar value of the shares remains the same compared to pre-split amount. So this is my way of saying that financially nothing really is happening here, okay? That the company's going to be worth the same, the shares are going to be worth the same, the dollar value of the shares is going to go down, but you're going to get a number of shares such that, you know, it'll still be worth the same. The most common split ratios are 2-to-1, 3-for-1, which means that the stockholder will have 2 or 3 shares respectively for every share held earlier. So if you had 1 share in a 2-for-1, you would now own 2 shares and the price would go down by half. Whereas if you're 3-for-1, for every share you owned, you're now going to own 3 shares, but the price is going to be cut by 2/3, so a third. Now, the major companies that are about to do it, so Tesla is doing this. You can see this is an announcement from 9 days ago here, where they're doing a 5-for-1 split of Tesla's common stock. So what this means, so Tesla has been on a tear lately. And Grant, I did see your question pop up there about the markets. I can speak to that in a bit. And Vince, I will get to your question about emerging markets just a little bit, but let me get through this stock split explanation. So, okay, here's Tesla's share price over the last 2 years. This has just been incredible to see it go from about $250 a share. I remember when it hit 900, right? This would have been in February. That it hit 900 mid-Feb, and it was just like, wow, I was so impressed, thought, you know, Tesla, okay, this is probably, you know, a little bit too high of a company valuation. From there, it did drop down in the crash, just like everything did, by, you know, almost 50%, probably a little bit more, 45%, but then it has just bounced back up, and not only to where it was in February, but it has since, I think, doubled in price. Yeah, look, it's about to crack $2,000 per share today, right? And this is up 6% in the last week. I'd have to make this like every day so that we can see, you know, just the meteoric rise over the last little while. It has just been on a tear. So right now, if you wanted to buy 1 share of Tesla, it would cost you $2,000 US. Now, obviously, this is a problem. Let's say you're a retail investor, you have a $10,000 portfolio. You're just getting started, right? You have $10K to invest. If you buy 1 share, that's going to be 20% of your entire portfolio. So what Tesla is doing is they are doing a 5-for-1 split, meaning that for every share of Tesla, right, you're now going to get 5 shares, which means that this share price, I'm just going to call it, let's call it 1990 divided by 5, right, means that shares are now going to be selling for $398 per share. Now, obviously, I don't know what the share price is going to be in a week when they actually do this, so, you know, but really what they're going to do is just do this little math division such that the company is still going to be worth the same. Tesla, the market cap is worth $370 billion. So if I wanted to buy every share of Tesla on the global stock market, it would cost me $370 billion. And then from there, you know, this is going to stay the same. It's just that they're now going to have 5 times as many shares in the world, and that each share is going to be worth 1/5 of what it is on that date. So that's how a stock split works in reality, that for every share that you own, you're going to get 5. Really what they're doing is they're trying to make it more accessible, more affordable, especially for retail investors. Now, in the US, they do have these things called fractional shares where you can buy half a share or a quarter of a share. We don't have that in Canada. So this is really going to be helpful for people that do want to have, shares, a share of Tesla or shares in Tesla, but don't want to break the bank and don't want to necessarily put a huge percentage of their money, especially if they're starting from a smaller amount. Another company that's doing this is Apple. So you can see Apple has actually done it a few times before. This is just like their investor relations page. You can see that they have done it. They did 7-to-1 in 2014, 2-for-1 in 2005, and 2000 and 1987. So they've done it a few times. What they've said here is July 30th, they announced a 4-for-1 split. And this is going to happen at the end of the month. So again, Apple right now, largest company in the world, largest publicly traded company in the world, has a market cap of over $2 trillion, which again is a little bit absurd that there's a company that large, but it is what it is. You can see Apple shares trading for, let's call it $470, right? So what they're doing is they are doing this 4-to-1 split. What this means is that for every share of Apple that you own, you're now going to own 4 shares. And what it means is that I expect this share price to go from $470, right, down to $117. So this is going to make it easier for retail investors to be able to buy shares of Apple. Really it's funny when it comes to share price. Personally, I'm a fan of these splits. I think it should be accessible. I like smaller amounts. I always say, I don't care how many shares you own. I care about the value of those shares. So I would prefer to have the smaller amounts just because it makes my math a little bit easier. I don't have to round as much. There are some companies like Amazon that should probably do a share split. One share of Amazon is worth $3,300, which is just ridiculous. If you're just starting off as an investor and it's like the minimum amount is $3,300, it's just absurd. The most ridiculous one is Berkshire Hathaway. I don't know. This is Warren Buffett's company. So they've got a few different shares, but the A shares, which is like the original shares of Berkshire Hathaway, one share costs $308,000, which obviously is just taking this to such an extreme. The way they did it is rather than splitting shares, instead they do have these B shares, which trade at $200 a share, so a lot more affordable. This would be a way for investors to buy into Berkshire Hathaway. So sometimes companies will have this second class of shares rather than doing these splits. So that's what's going on in terms of Tesla and Apple. Really, really interesting case with what's happening to Brookfield Renewable. Brookfield Renewable Partners, many of you would know this is one of my favorite holdings. I do own shares in this company. This is a renewable energy utility that trades on the Toronto Stock Exchange. So big fan of this company, that they do own all of these renewable energy projects. So they actually went forward with the split. This was announced on July 16th. So this happened a little while ago, a couple weeks ago. It happened on July 27th. So what they did is they actually created a new company. So this thing called Brookfield Renewable Corporation, which has its own ticker symbol. And what happened is the way they did it is that the holders of Brookfield's limited partnership units, this is the BEP.UN that we all owned before this, that for every 4 shares that we owned, we got 1 share of this new corporation. So this is a really weird way of doing a split that they didn't, it's not a traditional split. Instead, what they've done is they've created this new corporation. They've told investors of the old structure that you can basically, for every 4 shares that you own, you're going to get this like free share. What that effectively did is lower the share price for Brookfield. I remember there was one day, the day they did it, where the share price looked like it fell, but it's because it fell just as much as all of these new shares were worth, or at least a quarter of what they were worth, because you needed 4 units in order to get 1 of the new. of the new company. So, really it's been interesting. What this means is that if you owned Brookfield before July 27th, you now have this new share inside your direct investing account for Brookfield Renewable Corporation. It's been really interesting following why they did this. So basically, Brookfield, they do have different divisions, and they've been doing this across all of their different divisions. So this is Brookfield Infrastructure, BIP, right? And again, this was last year, September of 2019, where they did the same thing, where they created this new corporation. They announced the split. In this case, it was you would get 0.9, so one BIPC Class A share for every 9 units held is kind of how they did it. So it was really interesting kind of tracking that, and we can start to see some performance. So let me explain it first, and then then I'll chart it for you. So, Cucumber Pilot. Yeah, great that you're able to catch one of your streams. I'm so happy you're joining. It's a cool feature. I love doing these live shows. Thanks so much for tuning in. So when it comes to Brookfield, this is the new corporation. So you can see here they have this little explainer. We are giving investors the flexibility to invest in Brookfield Renewable either through the current partnership, LP limited partnership, or through a newly created Canadian corporation. So really the way that it works, as I told you, for every 4 shares of the old units, of the old shares that you owned, you got 1 share of the new corporation. From there, they are supposed to be economically equivalent, meaning that it really doesn't matter from a financial perspective whether you own the old limited partnership shares or whether you own the new Canadian corporation shares. That in terms of profitability, it should be the same, that they should be identical. And I have heard that these are fully exchangeable, that you should be able to go back and forth between them, which to me is interesting. And so if you are thinking of switching, because there are some slight differences from a tax perspective. So if you do want to go through, I don't know the mechanism for how we do that, but it does appear that you don't have to like sell and then rebuy, that you can actually exchange your shares. So know that these are designed to be, effectively economically equivalent. From there, the reason why they set up this corporation is that, they say expanded investor base, that they will be able to access more investors, but really I think it's about ETFs and some of the rules that some of the indexes have over ETF inclusion. So my hope is that this is now going to be included in more of these ETFs, which makes me really happy, and that there will be some tax advantages for some, which I'll speak to. So, you can see here, that really in terms of broader index inclusion, that they are on the S&P TSX, the Toronto Stock Exchange. So they would be in those, but it looks like they weren't eligible for whatever reason before under MSCI, which, a lot of the ESG ETFs use MSCI. Russell is also very popular when it comes to small and mid-sized companies. So the fact that these new corporate shares will be, or I guess should be, eligible for inclusion, this is a big deal with so many investors using ETFs. You want to make sure that the legal structure makes it eligible for those indexes and for those ETFs. Now, when it comes to investors, really the big deal with this new corporation is that 100% of the dividends are going to be considered eligible dividends and therefore subject to the Canadian dividend tax credit, which is really good news for any Canadian investors who hold this outside of an RSP or a TFSA. If it's inside a tax shelter, it really doesn't matter. What I want to show you here is, where is it? These are all the tax forms. Here we go. So this is, now hold on, this is European, and I want to see did they have it for Canadian? I felt like they did have, there was a slide. No, where was it? Here we go. Yeah, it is this. So here we go. Canadian dividend. So you can see here the way it had worked before is that there was a distribution. A Canadian dividend was 50%. From there, the return on capital. So this would be like a different form of distribution. And then there was actually a Bermuda dividend. So you can see here that it kind of was like, there was this weird tax form. If you held it in a taxable account, part of it was eligible, part of it was ineligible. It was a bit of a pain. What you can see here now is with the new corporate shares, 100% of the dividend is going to be eligible for the Canadian dividend tax credit. So I want to see here, hold on. I feel like this might have been from the US site, and maybe I was looking at it from the Canadian site. No, this should be it. But anywho, we're going to have to wait and see until after the first dividend. But, you know, really what I'm expecting here is that this is going to make paying taxes really, really easy. That basically you're just going to get an annual form, your T5 for dividends. Yeah, here it is. This is where I saw it. That now it's going to be an eligible dividend for Canadian investors. So really, if you hold this inside of a taxable account, you're going to want this BEPC unit. That, you know, you might actually consider shifting over your units from the old limited partnership and just holding this corporate structure. That said, if it's inside an RSP or a TFSA, it really shouldn't matter at all. Cool. I'm seeing some questions comes in about the ETFs. So why don't I give me a moment? That was sort of my spiel on stock splits and what that is. I have been getting some questions from people about sort of what's going on with Brookfield. So I did want to make sure to get through that. Give me, I would say, 10 minutes to go through my sort of state of responsible investing right now. And then I can get into specific questions on ETFs. It sounds like that's where the audience wants to go. So I'm happy to go there with you. Okay, so I'll get through this quickly. Really want to go through the state of responsible investing through the first half of the year. It's been such a fascinating year with the crash and then the recovery. All these questions about how responsible investments, sustainable investments, would perform in a downturn, right? Or in a bear market, in a bull market. We have lots of answers from this, and really it's looking pretty good. That so far in the second quarter, responsible investment funds continue to hold up well relative to their conventional fund peers. A significant majority of Canadian responsible investment funds outperformed their average asset class return in the 3-month period. So in the second quarter, more than half of responsible investments did outperform. And this follows the strong relative results in the first quarter when 83% of responsible investment funds outperformed their average asset class. What this means is that on the whole, responsible investments didn't fall by quite as much. That would have been that first quarter, through March, things were really quite low. But then also in the rebound, more than half of them have outperformed over the last 3 months, which is really, really awesome. We can see here some charts. Let me zoom in. So this is going to be Canadian equity. Oh, does it not let me zoom in on this chart? There we go. So, we can see here, that's fixed income. It jumped me down. So we can start with Canadian equity, right? So you can see here 74% of RI funds outperformed for the 1 year ending June 30th, 2020. So when we look at this, they didn't fall by as much as of June 30th before things got back up to where they were. You can see really the blue line that responsible investment Canadian equity has outperformed. Again, keep in mind that they tend to be lower weighted in energy. And over the past 5 years, energy has performed very, very poorly. Fixed income has been the same. Just this very, very slight outperformance really over the last year has done better. These neutral balanced, okay, fine. What I really care about is global equity. That, when it comes to global stocks, more than 71% of responsible investment funds have outperformed their average asset class return over the 3-month period, which is incredible. From there, you can see here over the last 3 months, over the last year, it's just been remarkable to see responsible investments 3 years and then 5-year returns. So, this is looking at Canadian domiciled funds, both ETFs and mutual funds, which is really cool. So this is my way of saying that responsible investments have held up very nicely during 2020 so far, which I'm thrilled to see these results. In terms of popularity, something really interesting is happening in the US. So this is from Morningstar, who I love. You can see here the headline, sustainable funds continue to rake in assets during the second quarter. So it's been remarkable watching funds flow into sustainable funds. This is all in the US. You can see that really, these are quarterly flows, so money flowing in. You can see that it never really got above 2 billion per quarter, right? It's kind of been languishing there. Then all of a sudden last year, whoa, 4 billion, probably almost 5 billion, 4 billion. Whoa, almost, 10 billion here. From there, so it was $20 billion was the number for 2019. And we've already seen $20 billion of inflow in the first half of this year. So this to me is showing that at least in the US, in 2008, 2009, when the market crashed, sustainable investing really got thrown on the back burner. Nobody cared about it. Everyone was like, back to fundamentals, let's stick with what works. Let's not try anything new. Whereas now in this crisis, we are seeing a huge bump in the assets of these sustainable funds. So really, to me, this is a signal that the tidal wave is coming, that I think a lot more money is starting to flow into ESG funds. And I think this really is gaining momentum in a very tangible way within the mainstream investment community, which makes me so, so happy. So really, this is super encouraging. I love to see this. Unfortunately, the number for Canada's haven't been as strong. Surprise, surprise, we are lagging here. So what's cool is that there have been all of these product launches. So you guys have seen, these are new mutual funds and ETFs. I've been covering a bunch of these, but so many new launches, 2019. And then we've already had, I think about as many. I think we've had, about 15 or 16 already so far in 2020. So, lots of new product. Unfortunately, assets under management hasn't been great. We're not seeing the tidal wave that we did before. You can see the line charts are the aggregate fund size. So this is like how much people have invested. Whereas the blue line, that's a little bit tricky to see, but this is net flows. And so you can see it's been okay. The blue line is kind of trending up. That in the first quarter, we did see these record inflows, probably over $1 billion. That said, in the second quarter, it has been disappointing. Barely any inflows. This is at 0 right here. So, really haven't seen the bump in assets in Canada that we've seen in the US. So, surprise, surprise, we're still a little bit behind the curve. That said, obviously I'm doing my part. Hopefully that we can have more Canadian investors picking up on this trend. So really, to me, what this tells me is that we are still very early on in the transition, but it is happening. If we look at the US, this sort of $40 billion, this $20 billion, flowing in, keep in mind that total ETF assets are about $4 trillion, right? So this is still a tiny percentage of the overall market. I would say we're probably in the second inning when it comes to sustainable investing here, that it is still very, very early days. But obviously, I'm really thrilled to see it getting picked up by mainstream investors in the US. All right, that's my overview for the first quarter or the first half of 2020. Now I can get in your questions, and we've already got some. So I'm going to get into the chat here and jump in. From Vince, hey Tim, great to have you back on the tube. Could you give us your quick and dirty take on XSEM? I thought the geographic exposure is pretty unique for a Canadian listed ESG ETF. And then I think there was another pickup. Oh no, that's on the different one. Okay, so with XSEM, this is going to be the emerging markets ETF that is here in Canada. This is the iShares ESG Aware MSCI Emerging Markets Index ETF. So really, there's been a huge gap when it comes to ESG products for emerging markets. That a lot of the launches that we've seen, Instead of the ESG aware, BlackRock did do these ESG advanced ETFs. They actually have a nice little fact sheet down here that sort of shows the two different families. So there are these ESG advanced, which are the fossil fuel free ones, which I went through with great detail a little while ago. And then they've got these ESG aware ETFs that have been around longer. I think these launched, I want to say about 2 years ago. And you'll notice that when it comes to the ESG advanced, it really only is just Canada, US, and international, which they call this EAFE, Europe, Australia, Far East. So this is only going to be quote unquote developed countries, and you're not going to get exposure to emerging markets. So when it comes to the iShares lineup, iShares, really it's this ESG aware is the only option that we have for emerging markets. And that's also the case with a lot of the other funds. That when it comes to BMO ETFs, let me just see if I can get to their page quick. They came out with their sort of ESG family, which, I like that they have this nice sort of all-in-one, this global one that I can show you. But when we look at the global, you can see it's a mix of Canada, US, and again, EAFE, Europe, Australia, Far East, that BMO did not launch an emerging markets ETF for this ESG Leaders series. In the same way, Horizons doesn't have exposure to that. The Wealthsimple ETFs don't have exposure to emerging markets. Really, the only other one on the market that does have exposure to emerging markets is from Desjardins, their RI Global Multi-Factor Fossil Fuel ETF, that this is a truly global option because it does give us exposure to emerging markets. You can see here China is in here as well. We have India and lots of other emerging markets, Mexico, Chile, etc. So really, I would agree with you, Vince, that this ESGE is a very, very unique product in that this is the only way to be able to get emerging markets exposure while staying in Canadian dollars with this sort of ESG mandate. I hope there are going to be more products, but for now, this is it. There are some US dollar emerging market ESG ETFs that I could show you, so that there are a few other options if you're willing to go into US dollars. And even I was looking with a client this morning, and the fees on this one, the Canadian one is, 0.36, whereas if you're willing to do US dollars, then there is ESGE, which is the US dollar of this ETF. Again, this is the iShares ESG Aware Emerging Markets ETF. Everything's the same, but it is in US dollars. And you can see here the expense ratio is actually a little bit cheaper. So, emerging markets have been a tricky issue. They're really hard when it comes to ESG analysis. There's not as much disclosure and transparency there. So, really, really interesting to see that. But absolutely, you're right. XESM, very, very, I would say I'm really glad that this product exists. If I'm real with you, my quick and dirty take is that, it doesn't go that far when it comes to the ESG side of things. So, it's not going to be fossil fuel free. So for a lot of sustainable investors, especially if you want to stay in Canadian dollars, you just might not have emerging markets exposure at this point. That said, if you do want proper diversification, then this is going to be the best way to do it right now. So from there, Vince, also curious if you've heard any rumors regarding Horizons launching some more squeaky clean Canadian ETFs to complement the likes of ETHI. So I would love for Horizons to launch more funds. I did hear rumors a little while ago that they were going to do an income product. So, maybe like dividend and income, something like that. But it just hasn't materialized. I haven't seen anything. I haven't seen any filings or anything like that. My contacts there, I feel, would let me know because they know how excited I would be about this product. So, I would say nothing in the pipeline right away. I did get to meet the CEO of Horizons at a conference. It was probably a year and a half ago. It was at the Money Show, so I'd say probably about a year ago. And I asked him the question about ESG and sustainable investing. And this is after they had launched ETHI. He was still pretty pessimistic. He seemed to think that it was about 5 years away from going mainstream. And, you know, if I'm honest, he's probably right. Like, ETHI, at least in terms of Canada, hasn't been crazy popular. That if we look at the assets under management, I mean, it's north of 30 million right now, which is good. That means that it's climbing. But, you know, it's still not where, you know, you really want it to be. Just to give you a comparison, I think it's Beta Shares. This is the Australian version. So the ASX is the Australian Stock Exchange. This is the same ETF that trades on the Australian Stock Exchange. And the last time I checked, it just had so much money. Wow, look at it. $771 million, which is just so much more than we have in the Canadian version. This is absurd. So, you know, don't ask me why the Australian one is just so much higher and the Canadian one is just really, really lagging, but it is what it is. So, you know, if I'm real that this number has to keep climbing and, you know, probably at a bit of a quicker pace before I feel that Horizons leadership would really be like, okay, gung-ho, you know, we're going to go after this market in a really aggressive way and have lots of new ETFs. So haven't heard any rumors. Well, I did hear that one rumor, but it hasn't really materialized. So I'm not holding my breath there. And, you know, my assessment is that it might take a little bit longer. Jonathan asks here, following up on Vincent's question, is the combination of ETHI 2/3 and SDG 1/3 still your favorite idea for the equity component of a squeaky clean portfolio? Yeah, when it comes to the squeaky clean, I do think about 2/3 and 1/3. That feels right for me in terms of the diversification across a couple different ways. Let me see if Morningstar is working here. Morningstar.ca. So Morningstar has been a little bit funny for me this week. I haven't been able to get all of the information. Let me see if it happens to be working right now. Yeah, it's just no growth data. See, it's just weird. For whatever reason, it's just not populating. And even when I checked it yesterday, it had a little banner being like, bear with us, things are a problem. So I can't like show you the math right now. But basically what I'm trying to do with this 2/3 and 1/3 breakdown is to get us, you know, relatively close to the US market exposure from the All Country World Index. So, you know, again, the All Country World Index, I'll just like walk you through my logic here and I'll double check my math because, you know, I did do this a little while ago. Oops, actually I want ACWI ETF. Here it is. I want the actual iShares version because what I want to do is show you the geographic exposure for the All Country World Index. Here it is. So you can see the US is at about 58% of the global market. Now, slight grain of salt here because with this, you know, I would say somewhere between 55 and 58. I know there are a couple things in here that count as US that really shouldn't be. I think it's in the top 10. Yeah, here's this iShares MSCI India ETF where obviously this is India, but it does count for the US. It doesn't say here, but when I put the country in there, they do count it as US. So, you know, I would say we're aiming for like 55 to 58% US exposure. When it comes to ETHI, the exposure is really, really high. So you can see here that it is about, you know, sector exposure, about 70.53. So if I do like 70.53 times 2/3, right, gives us about 47. And then plus what I'm aiming for here is when we do SDG. And here it's going to be about, I think it's about 30% US exposure. Yeah, 31.20. So I can do times 31.20 times bracket 1/3, just to prorate everything, gives us 57% exposure to US. So that's my logic. That's how I got that 1/3, 2/3. I am really sort of benchmarking it around US exposure. I'm not benchmarking it around emerging markets or anything like that. That's really the metric that I was trying to aim for when I came up with that split. So it looks to me like this is absolutely like very close to the benchmark. This is where I want it to be. So that's how I came up with that logic. Obviously, it's up to you to kind of play with it. But, you know, to me, that still makes sense. This is probably the best measure that I can use in terms of coming up with what is the proper breakdown between ETHI versus SDG. One, it just kind of feels good. It's intuitive, that kind of, you know, 2/3, 1/3. And second, you know, really what guided me to that breakdown was this US exposure. So hopefully that explains my logic. Curious to hear your thoughts. Let me know in the comments if you think that this is a good approach or a bad approach. You know, certainly welcome to feedback when it comes to those model portfolios, but it is what it is. That's why I decided. And, you know, I'd love to hear your comments there. Okay, Tim, what are your thoughts on ZUT? Oh, I'm getting some more questions here. This is awesome. Okay, great. So what are your thoughts on ZUT? Should we buy the individual corps like Brookfield or just buy ZUT for simplicity, but then pay for the convenience with the MER? So, okay, I do have some issues with ZUT because this is your equal weight utility. And there's going to be a lot of things in here that, frankly, I don't want to own. So if I show you here, let me just look at it. Where is it? It's gonna, I hate BMO. The way that I have to search for things on their website is so annoying. At least I figured out how to do it so that you don't have to wait too long with me, but I have to go to their site and then search on their site. So if we look at the holdings in here, this is going to be equal weight utilities. So the renewable energy ones have done well. And remember that these are equal weight. So, you know, at the start of the period, usually the rebalancing period is like quarterly, usually. I don't know for sure on this one, but that'd be my guess. Let me see if I can find out if it's quarterly. Does it tell me? No, I'd have to dig into the index. The distribution is monthly, but I'm guessing the rebalancing is quarterly, meaning that, you know, they are going to be all even at the start of the quarter, and then you can see which ones have been doing well because they're going to be overweight sort of in the interim. So the renewable ones have been doing well, which is why it's great. So you can see Northland Power, Intergex, Boralex, TransAlta Renewable. So, you know, if we look at a company like TransAlta, this is a great example of, you know, something that is just going to have a really high carbon footprint. That the parent company, TransAlta, does own a whole bunch of power plants that are fossil fueled. I don't know whether they've gotten rid of coal. I know they were like in that direction. You can see this like coal to gas, that they are in the process of transitioning. But, you know, if we do look at, and it's funny, they're promoting TransAlta Renewables on their website. I just want to see here if they do tell me, no, there's like no map here. But diverse fleet includes hydro, wind, solar, gas, and coal plants. So, you know, to me, that would just be, you know, a problem. And then they do have in the US, again, coal. So, you know, I don't think I can get it on Morningstar right now. Let me see if MSCI, I can get the ESG fund ratings. I don't know how good their Canadian coverage is. Oh, it is in here. Fantastic. Which means that it has a AAA rating, which is awesome. But what I'm going to be concerned about is this brown revenues. That 21.3% of the total revenue is generated from fossil fuels, right? And then when we see this weighted average carbon intensity, holy crap, this is one of the highest numbers I've ever seen when it comes to carbon intensity. So this is going to be really carbon intensive with a lot of coal plants in here. So, you know, that's why my preference is going to be to own the individual companies when it comes to this ZUT. Not so much for like, you know, I think you can make the trade-off yourself of like fees versus complexity, right? The ETF is going to have higher fees. It's going to be a lot simple, whereas the individual companies, more complexity, but no management expense ratio. That said, for me, just the amount of coal in here is kind of a deal breaker. There is an ETF. I would love to see this replicated in Canada, but it is a US dollar ETF, which is the Yieldco and Renewable Energy Income ETF. So this is going to be similar. It's still going to have a lot of those utilities, but it's going to get rid of the nastiest ones. So you can still see it's like 90% utilities here. When we see what's in here, Northland Power, Algonquin, they're all going to be in here. Brookfield Renewable. It is more of a global fund, so it does have the international ones. And that where was that MSCI? Did I get rid of it? Probably. MSCI ESG fund ratings. The carbon footprint on this one is going to be way lower. So you can see it's still AAA, which is great. This still does have some brown revenue. It still does have, look at this, a fairly high weighted average carbon intensity, but not as absurd as the straight up regular utility is. So when it comes to this yield coat, there is still some fossil fuels in here. It's not what I would consider fossil fuel free. You can see it skews much more towards green than the traditional ones. But honestly, at this moment in time, I would say just own the individual companies. That would be my suggestion, is just go through, pick the ones you like, look at their share of renewable energy to non-renewable. And I really think that when it comes to these Canadian traded utilities, that you can pick the renewable energy ones and just own them individually. So as long as you're fine with the complexity, I do feel like that's going to be the best way to do it for now. Hopefully that answers your question, Philip. Vincent, okay, my partner in crime, Daryl, is all about the bonds. Do you think there is a case to be made for holding a 100% stock ETF portfolio if you have a long time horizon? Bond ETF returns likely to stay low. Oh, Daryl would say, no, you're a fool for that. I would say you're very risky. You're taking more risk than you need. The diversification benefits from bonds are so great. Vince, even doing 10% bonds, really, I would stick with 20% bonds would be like the low end of the threshold. That way you do have bonds so that you can rebalance as needed. If you don't have those, you can't really rebalance between stocks and bonds. So the reason we own bonds for a long-term portfolio is not for the returns. That's not why we own them. The reason we own them is for the diversification benefit. That since we are assuming that we're buying global stocks, we want something that's inversely correlated. So you could do it as cash, or you could do it as, another low risk investment that is inversely or uncorrelated to stocks. But really, I'm going to want you to be able to have some cash for when the market does crash. That's when we want to aggressive and buy, right? That if we looked at the All Country World Index, that, had we had the chutzpah to be able to invest at the low point, or really anywhere in the month, you didn't have to nail the date. You could have bought any point. That's really when you do make money long-term with the stock market. So unless you're prepared to have cash on the sidelines, ready to invest when markets do fall, I just like having bonds, and then we rebalance, and then it's simple. So that would be my suggestion. Certainly if you ask Daryl, he would tell you, put a decent amount of your portfolio in bonds. I'm telling you, do at least 10 to 20%. I want to say 20%, but I know if you're okay with risk, 10%. But the difference between 90% equity and 100% equity in terms of returns is not that massive. You're not giving up that much return. And the benefits that you get from diversification are worth so much that I would really enjoy that. Okay, Serge here asks, on the other hand, the 3 advanced ESG iShares ETFs launched in April, no GMO, no for-profit prisons are still all below 10 million. Yeah, I know. I mean, ETFs, it takes time. What was really interesting is, again, with the US dollar ETFs, that a lot of institutions, a lot of foundations just put their money into them right away. That the iShares brand, they were just yeah, okay, great, we'll do this. That hasn't happened in Canada. I don't know if any institutional investors are buying these ESG ETFs, and it's sad. I'm sad that they're not, because it means they're either overpaying for full service managers, or they're not doing ESG. They're just buying the standard ETFs. So, all of these ETFs, if we look at, what it's like XCSR, I think is the biggest one. And net assets, 3.4 million. XUSR should be still very small, 2.23 million. XDSR, still very low at 6.5. Okay, so this is actually the most popular so far of the three. So, still very, very low assets, which again, it's just Canadians haven't really been doing this. When I looked at that net inflows for Canada, very low for the second quarter of 2020. And these guys all launched in April. They launched in the second quarter of 2020. So they are really low right now, which is too bad. The two that are kind of like the outliers for this are the ones from Wealthsimple. If it's important to you that there is more assets under management, then the Wealthsimple ones are pretty high. Oh, that's interesting. They don't have it here. Let me see if I can get it on Morningstar. Again, Morningstar's website has just been really annoying. That it is popping up now, which is great, but no data. Oh, that's so annoying. But I was looking at them. I looked at them the other day. The Wealthsimple ones each had about over 200 million. And that's because Wealthsimple did shift all of their clients in the socially responsible portfolio over to these new ETFs. So WSRI and WSRD each had about, I think it was $225 million under management, which is pretty awesome. So, to me, that's kind of a cool place to go. Okay, question from Tobarius13. My thoughts on Etho. So Etho is a really cool one. I haven't looked at it for a little while. This is a US dollar ETF, and they do have a bit of a funny methodology here. So Etho Capital, you can see here they only have the one ETF. It looks like they've changed the website. Okay, when I saw this, I assumed it was like a review site or something like that. Anywho, okay, so Etho, socially responsible and fossil fuel ETF, fantastic. We love it. 5-level screening and weighting process to put emphasis on companies that are not only socially responsible and meet ESG guidelines, but also have strong operational efficiency against their less sustainable peers. And system of stock selection pioneered by a Stanford environmental science lecturer. So, really they do have a bit of a unique approach here. When we look at what's inside of it, I will chart it because it's been around for a few years. But let's download all the holdings. So, they're not going to use a cap-weighted approach, meaning that, so let me get here. These are going to be the names of the companies. And then really what I care about is the weighting. So let me just get rid of these guys. Perfect. Okay. So all I care about are these two columns right now. So, you can see Tesla in here, SunPower, First Solar. This is still what I would consider like a doing less evil fund, but they are actually really shifting towards a doing more good approach with heavier weightings for, diagnostics. I assume this is medical devices, Tesla, SunPower, First Solar. Here's Hannon Armstrong, who I do love. When we look at the companies, Apple is in here at 0.5%. Beyond Meat is in here, which is super cool. I haven't seen that in too many ETFs, so I do like seeing it in here. I think there are about 100 companies overall. Let me check that. No, it looks like they've increased it. Okay, that makes me happy. Whoa, actually quite a few companies. Intel down here. So, about 266 companies overall, which is pretty cool. You can see the weighting, is a little bit funny. It wouldn't surprise me if they start with the equal weighting. And then again, it tells me that the companies at the top are the ones that have done really well since the sort of the rebouncing process went through. But what this means is because it's not cap weighted, that it does have more exposure to smaller companies. So something like Beyond Meat, which is a fairly small company, can be worth 0.5% here, as much as Apple. So let's chart it. Let's see how it's performed. So let's look at the All Country World Index, ACWI, my standard benchmark when it comes to the global stock market. Actually, you know what? Let's look at this compared to SPY. This is just a US equity ETF. So because it's just US, it's not global, SPY, which is the S&P 500, is probably going to be a better benchmark. Let's look at it over the last 5 years so that we can see when it started. And we'll do ETHO and its climate leadership, so I will give it the green color. And we can see here that it has outperformed quite substantially. And it looks like it's been around almost 5 years, right? That this would have launched in 2016 or 2015, end of 2015 it looks like. And that it has kind of maintained its lead, which is pretty cool. Let's look at it in the crash. So since February 10th, I'm always curious about, just to see it go down and then come back up again. So if we do February 10th, which was right at the peak, so you can see that it looks like it did fall a little bit more than the S&P 500, which again, with more exposure to smaller and medium-sized companies, I would expect a bit more volatility, which means that, I'm not surprised that it did drop more than the S&P 500 at the low point of the crash, but that it has bounced back a little bit better. You can see how closely it does track. That's pretty impressive, and then again, let's look at the last 2 years that it has tracked very, very closely. So this is an ETF that I would say is like doing its job really well while also being very sustainable. It is in US dollars. The fees on it are going to be a little bit higher. They do tend to be about 0.5%, I think. Let me see if I can find it here. Is it going to give me the MER? I might have to look up the fact sheet. So anyone, oh, here it is. Expense ratio 0.45. So I was pretty spot on there, absolutely in the range of all these things, and about 89 million under management, which is good, not great. I would love to see it crack the 100 million. That's when I feel really good about ETFs and kind of give them a congratulations. That's usually about when they break even. So the company would start being profitable, which means they might be able to launch more ETFs. So all in all, ETHO, I like it. Like, it's in US dollars, reasonable expense ratio, it's done well, gives us a nice broad, diverse mix. Really, I think this is a great option, especially if you're open to those US dollar funds. Cool. Okay, off-topic question. Oh, here we go. Oh, getting more questions. This is great. But as a very beginner investor, would it be better to leave the bank mutual funds, TFSA, I have alone, given the delays when selling, and open a Quest trade, or transfer the money over? So, okay, Cucumber Pilot, yeah, no question to off topic for me. So I can certainly help with this. So really what you want to do when it comes, if you've got a TFSA at a bank in mutual funds, what you're going to want to do is open a Quest trade account or whichever online broker you want to go with, right? You want to open up your account first. So you would open up your TFSA at Questrade. You would then do what's called a transfer account to Questrade form. So you would make the request from Questrade to transfer your bank mutual funds over. Now you're probably going to want to do the transfer all in cash. What this means is that you're telling your bank to sell your mutual funds and then move all of the cash over to your new Questrade TFSA. Now, two problems with this. Number one is that it's going to take time. It can take 6 to 8 weeks for those transfers to go through, which is just absurd in this day and age. But it's literally like paperwork and faxes, and the CRA is involved because it's a registered account. So, the problem number two is that you are going to be paying what's called a transfer out fee. It's usually about $100 or $150 depending on your bank. And you can get Questrade to cover this for you. So as long as you get a receipt and you provide documentation and your portfolio is large enough, I think it has to be like $25,000, $25,000. But if it is and you submit that, then Questrade, they want your money. They will actually cover that transfer out fee for you if you ask. Now, that said, if you really are just getting started, if you're a beginner and we're talking about like 5K here, 10K here, something like that, what you might want to do, what might be a lot faster for you, is going to be to actually sell the mutual funds at the bank and withdraw the money manually from your TFSA. From there, open up the account at Questrade, open up your TFSA there, and then manually put your cash into Questrade. That should happen in about a week. And there's no transfer out fee to do this. You have to make sure sometimes there is a deregistration fee if you close your TFSA. They're rare, but these banks, they do like to ding you. The only reason you would want to do this, obviously it's quicker and there's no account transfer fee, but the downside is that you do lose your TFSA contribution room for the rest of the year. So the only time we would actually do that, sell and then manually get it inside your new account, is if you had lots of room inside your TFSA. If you've got lots of room inside your TFSA, then no problem. You can do this. Let's say, it's $5,000. You sell, you withdraw that $5K. You lose that $5K room this year, but you'll get it back on January 1st of next year. That your TFSA contribution, whatever money you pull out, you get that back on January 1st, which is why TFSAs are so much more flexible. So it would be quicker. It might be cheaper. If you're anywhere near your TFSA contribution room, your cap, if you think that you might go over this year in 2020, don't do it. Do it the old-fashioned way. Open your account at Questrade, fill out a transfer request form, wait, weeks for that transfer to go through. But if you have lots of room in your TFSA, you might actually just be better selling, pulling it out, opening up your new account, manually getting the cash in there, and then probably within a week, you should be ready to buy ETFs with that cash. So hopefully that answers your question. I would say that, at this moment in time, because the VIX is low, now is probably a good time to make this type of move, to be able to shift your investments out of a really expensive bank mutual fund and get them into ETFs that are going to be a lot cheaper from a fees perspective and that are also probably more aligned with your values. Mark says XCM is just a wrapper for ESGE. Yeah, that's right. That's what I mean when I say they're the exact same thing. So, with XSEM, if we look at the holdings that are in it, this is the Canadian dollar version of the ETF. Mark, you are spot on that when we look at the holdings, that really the entire holding is this ESGE, iShares ESG Aware MSCI Emerging Markets ETF. So this is why, that it is going to be cheaper to be able to hold simply the US dollar version. You can hold ESGE. It also is a little bit more tax efficient from a foreign withholding tax perspective. I don't want to jump down that rabbit hole. But this is why some of my clients, if they're okay with US dollars, will just look at the US dollars for emerging markets ETFs. That said, if you wanted to stick in Canadian dollars, just for simplicity's sake, that's where XCM really shines. Serge writes, Mark, yeah, so you get hit with an extra layer of US withholding tax. Exactly, which is why the US dollar one, again, is going to be more efficient, is going to be, cheaper for a couple different reasons. But, hey, simplicity, right? I've long had to, find this trade-off between optimization versus simplicity. And I got to say these days with a lot of my clients, I'm erring on the side of simplicity. Depends how complex you're prepared to go. Serge says, I found USD ETFs exposing to one emerging country each. Then I checked, don't have super high ESG scores, which seems logical to me. Yeah, when it comes to emerging markets, ESG, it's behind and it's slow. So it's going to be really, really tricky there. Vince asks a question about good investing. Any plans on offering services related to insurance, planning, tax planning, estate planning? Oh, I would love this. For now, I'm really, really focused on investment planning. I think this is the highest value thing. I think this is where I have my sort of search engine optimization. I think this is where people need a lot of help and frankly, what I'm most passionate about. So, really I want to get good investing up and running to the point where I do have a little bit of passive income, that I'm not just getting all of my revenue from meeting with clients day to day. It can be quite exhausting having that many client meetings in a day. Oftentimes it's 4 or 5 client meetings. So, really I want to take the next, I would say, year or two to develop an online course, to likely hire some other investment coaches. Daryl has been fantastic, and I'm doing my best to try to keep him busy, but I do need more demand. I need more demand for my services so that I can hire more people and grow the business. Once I'm really comfortable there, that's when I'm going to start to expand these other areas. Really, to me, disability, I think would be fascinating. I've helped a number of clients with their RDSPs, registered disability savings plans, and I think there's a lot of important work there. I don't really care about tax planning so much. Honestly, like helping wealthier people avoid taxes doesn't really resonate with me, but I love the idea of estate planning. I think we really need better conversations around estate planning and legacy and donations and this intergenerational transfer of wealth. I think is so important. So really, to me, if there's one of these areas that I think I'm gonna, expand towards, it's probably gonna be estate planning. But certainly don't hold your breath. That's probably a medium-term plan for me. That I really want to get the investment coaching up and running and really have, accessible ways for people to invest according to their values before I start expanding into these other areas of financial planning. Mark writes, NUEM from Nuveen and RESC from Wisdom Tree, two other examples of US listed emerging markets, ESG funds. Absolutely, there are more options in US dollars, which is pretty cool. Jonathan writes, how would you feel about using the Deetkin Impact Bonds, 5% annual interest, for the entire bond component of a portfolio, assuming a long-term investment horizon? Oof, this is a big question. So first of all, let me just show you Deetkin Impact. They are so cool. Unfortunately, it's only available to accredited investors. I would just love for them to have a retail offering. But you can see here, really cool impact stuff. And I want to see if they do have the little fund sheet. So here's the impact bond, 5-year term, $25K minimum investment for individual investors, but not retail. Has to be, I believe, accredited only. Earning a fixed 5% term and then locked in for 5 years. So really, what I would say to this is that, Jonathan, I would have huge concerns with only doing Deetkin. And the reason for this is the lack of liquidity. It really comes back to what I said earlier on about 100% equity portfolio, that the reason we own bonds is for diversification and the ability to rebalance. Now, this does give us some nice diversification. And I do think private investments, these, community bonds, green bonds, impact bonds, do help when it comes to diversification. So I like it for that reason. But these are not liquid. These are locked in. So, during the crash, when things were down, that's when we want to rebalance our portfolio. That's when we want to sell some of our bonds, use that money to buy stocks when they're cheap. We can't do that because these are locked in at a 5-year term. Now, if you could set up like a ladder such that, these renew and every 6 months, part of your money came due so that it was available for rebalancing, that would help. But, especially at a 25K minimum, for a lot of people, that's going to be like, a big part of their bond portfolio. That really, to lock it in for 5 years means that you're not going to get that benefit and the ability to rebalance. So I would be really cautious about using impact bonds as your only fixed income or bond investment. I really do like having ETFs, bond ETFs in my portfolio just for that liquidity and that ability to rebalance. I hope that helps. Mark, that YLCO, that carbon intensity was interesting. It's still pretty high, 1200. Obviously a lot lower than the other one. Philip, thank you very much. Oh, I'm so happy to help. Dollars Phil, hey Dollars Phil, can buy TIPS ETF if there's inflation because the Fed is printing a lot of money. Okay, so there are these TIPS. What are these? Treasury inflation protected securities. It's interesting. I've been looking at this. I'm not too concerned about inflation right now. I know that the Fed is printing a lot of money. I know that, money supply is growing. I don't necessarily think that means inflation. If I'm honest with you, I think I'm almost more worried about deflation. or like, I don't know. I don't know. Honestly, I just don't know. But yeah, these tips, this is something, I think it's only available. Do we have one for Canada? Oh yeah, it's this, it's not quite there. And I remember looking at this, that there are some problem with the inflation protected bonds here in Canada, that they don't have a lot of options here. So you can see here, the market for real return bonds is far more limited. So these are going to be inflation adjusted government bonds. You can see here, designed to protect investors from the effects of inflation. So basically, both the face value of the bond and interest payments are pegged to the consumer price index, which is CPI, which is the measure for inflation, which means that you're guaranteed to maintain your purchasing power over the life of the bond. They are, useful in theory, and in the US, there are some better options for this. But you can see here the theory isn't easy to put into practice in Canada. In the US, these TIPS, Treasury Inflation Protected Securities, are issued regularly with 5, 10, and 30-year terms. So there is an active secondary market, which is great. But in Canada, the market for real return bonds is far more limited. So you can see here, they really only did it, they generally issued with 30-year maturities and in much smaller volume. So, you can see here that the main holdings, what we end up with here is like, really very high concentrations within this one bond. Just because they don't have as many. So, normally I would expect to see hundreds, if not thousands. But here you can see between 1, 2, 3, 4, 5, 6 securities, that's going to account for like, between 70% and 99% of the ETF's holdings. So, tips, some cool stuff there. But, for me, I'm a little bit concerned about them. As well, there is some volatility because of these long maturities and low coupons. So, interesting, certainly something to look at with these inflation protected bonds. I'm not super worried about inflation, although I know a lot of people are. Maybe that's something I can cover in a future show. But great point, Dollars Phil. Absolutely. These are a good option. If you are worried about inflation, this can be a really cool option for those bonds. Beard to here, many thanks, gotta go, but found your talk on stock splits very helpful, fantastic. A lot of people probably wondering what's going on with those Brookfield shares. Thanks, Tim from Tiberius. Thank you for joining. Cucumber Pilot, thanks a lot. Really appreciate you joining. Jonathan, terrific advice today, Tim. Oh, I'm so glad. Would you add YLCO to the equity component of an ETHI plus SDG portfolio to add some utility exposure? If so, what percentage would you recommend for YieldCo? 5 or 10% of a portfolio? Yeah, this is really going to be, I would say, like a preference thing. That if you wanted utilities, YLCO, definitely you can see. I do like that option. A lot better than a traditional sort of utility ETF. It's really up to you. The question is, how much utilities do you want? And I can't really answer that to you. I would probably lean a little bit more towards 5% because for me, it's not a sector I really want. I'm not as concerned about dividends. I'm more focused on growth. I'm on the younger side. So to me, more interested in growth. That said, if I was older, if I was starting to approach retirement, then yeah, I could easily go to 10%, something like that. Really, that's going to depend on your asset allocation. It's going to depend on your time horizon. It's going to depend on your risk tolerance, all of that fun stuff. So if you need some help talking through it, feel free. Happy to do that. I do this type of stuff with clients anyway. That said, 5-10%, honestly, that sounds good to me. Really, as long as you understand what it is and how it fits into the overall pie chart, then, I would lean more towards 5% than 10%. But if you really like those utilities and you really like those dividends, then 10% would be fine. Lauren, thanks, Tim. Great show. Have a good vacation. Thank you so much. I'm so excited to sleep in and take my dog for long walks on the beach. And my fiance, it'll be the three of us. But, really excited to be able to have some rest and enjoy lots of good things going on. So thank you so much for everyone for joining. This was a great show. We went about 80 minutes, but I think this was great. Thank you so much for joining. It means the world to me, all of these wonderful questions, and really happy to be able to spend this time with you. And hopefully I've been able to help you out and shed some insight onto some of these wonderful trends. If you've listened this far and you haven't already, please like the video, give me a comment in the video, subscribe to my channel, help that YouTube algorithm be my friend so that more people can see my wonderful content. And hope everybody has a wonderful rest of the summer, and I'll see you in September. All the best.